Welcome to the Deep Dive. Today, we're taking on a really critical mission. We're going to synthesize the analyses around one of the most drastic economic resets in, well, recent Caribbean history.
We're diving deep into the sources that are trying to map the future of Jamaican real estate. This is all in the wake of those catastrophic back-to-back hurricanes, Beryl in 2024 and then Melissa in 2025.
And the way the sources frame this is it's unforgettable. They say Jamaica right now feels like a half-finished house that's been hit by two storms before the roof was on.
It's a powerful metaphor, and it's not just about infrastructure, it really speaks to the disruption of all this forward momentum the country had. The foundation is strong, the national spirit is there, but the vulnerability has just been laid bare.
Exactly. And that brings us to the core question everyone is asking and what our deep dive is centered on. What happens next?
Right, and this isn't a simple recovery story. The sources are clear on this. This is about a forced, immediate change in how property is valued, how it's built, how it's financed, even how it's insured in Jamaica from now on.
So we've broken it all down for you. First, we'll get into the specifics of that 1-2 punch from Beryl and Melissa.
Then we'll analyze the structural market forces that came out of it, the three certainties for the 2026 outlook.
And finally, we'll distill the actionable advice, the playbook, for the four key groups caught in the middle of this. Homeowners, landlords, buyers, and renters.
Okay, let's start with the storms themselves, because the chronology, it really matters here.
It does. Our sources describe Beryl as the storm that cracked the plaster. It exposed the weaknesses. But Melissa was the one that tore out the wall.
That's a vital distinction. Beryl hit on July 3, 2024. It was a serious storm, a Category 4. It caused significant damage, no question, but it felt survivable.
Survivable, but the numbers were still alarming. We're talking over 13,500 homes damaged, 500 municipal roads just torn up.
Yeah, which immediately hits commerce, mobility, everything. And it really hammered parishes like St. Thomas, Portland, and Clarendon.
So what was the economic tally from just Beryl alone?
The Planning Institute of Jamaica put the number at $32.2 billion. That's about 1.1% of GDP. But the real immediate pain was the drop in economic activity. It fell 2.8% in that quarter.
So the country was already on its back foot.
Completely. Growth forecasts for 2024 were slashed almost to zero. So the country was incredibly vulnerable going into 2025.
And then, just 16 months later, the system got a stress test it just couldn't handle.
Exactly, Melissa. October 2025. It wasn't just another storm. It was a Category 5 monster, a direct hit. And what's really sobering is how the sources talk about it. They say Melissa shattered the illusion that these are, rare, once-in-a-generation disasters.
Right, 2 in 16 months. This is the new reality.
It is the new operating reality.
The scale of Melissa is it's hard to comprehend. Early assessments were talking over 100,000 homes damaged or completely destroyed.
And that directly affected about 1.5 million Jamaicans. That's over half the population feeling this immediate, profound loss.
So that brings us to the big number. The total economic damage.
The sources estimate it's approaching US $20 billion.
$20 billion. Just to put that in perspective for everyone, that figure is massive. It's almost half of Jamaica's entire annual GDP. This isn't a setback.
No, it's an economic reset.
So how do the sources get to a number that high? It's not just homes, right? What else pushes that total up?
It's the critical, high-value systems. We're talking about catastrophic failure of the energy grid, of major ports, critical highways, communications. Melissa didn't just cause flooding, it triggered huge landslides that destroyed the very routes needed for recovery.
The commerce just stops.
It grinds to a halt. Agriculture losses alone were over $29 billion.
Yeah.
When you can't get goods out and you can't get rebuilding materials in, the economic damage just spirals. That's how you get to that $20 billion mark.
It's staggering. But the sources argue the real story isn't the damage itself, it's the psychological shift, the assumption that this level of risk is the new baseline.
That's it. And that brings us to the structural shift in the market, the three key certainties for 2026.
Okay, let's unpack them. Certainty number one.
Supply will be low and stay low. Now, this seems obvious, but the reasons why it will stay low are complex.
Right. It's not just about the time it takes to rebuild. The sources talk about major constraints. Let's start with labor.
The labor market is immediately squeezed. Demand for skilled trades roofers, masons, plumbers, it's gone through the roof nationwide, and many of the workers were themselves displaced.
And materials.
Inflated. International suppliers know there's huge demand, and getting anything through damaged ports just adds cost. But the biggest constraint, the real structural one, is financing.
Okay, so what does tighter financing actually mean for someone trying to get a loan to rebuild their house?
It means higher hurdles everywhere. Banks are under pressure from their own reinsurers, so they're demanding much higher equity. We're talking 30, maybe even 50% higher down payments in some cases.
Wow.
And insurance companies are now basically dictating construction methods. Certain types of zinc roofing, lack of proper strapping, that's now grounds for being denied coverage or facing insane premiums.
Which leads to a critical point from the sources.
Yes, entire areas, known floodplains, unstable slopes are going to be deemed uninsurable, which effectively freezes them out of the mortgage market.
So you have this huge, institutionally driven drop in available housing stock. But then you have certainty number two. Demand will stay high and maybe even go up.
It seems counterintuitive, but yeah.
So who is driving all this demand?
It's a mix of things. You have necessity, all of those displaced families, but then there's a flight to safety. The returning diaspora, other Jamaicans, they're all seeking safe, resilient homes. They see this as the moment to buy into the most secure structures possible.
And speculators.
And speculators, of course. Long-term investors buying damaged assets at a discount, betting that the nation has to rebuild. All of this just concentrates demand, especially rentals, in the few urban centers that prove they could withstand the storms.
Okay, this is where it gets really interesting. Certainty three. With so much destruction, you'd think prices would just crash across the board.
Right, conventional wisdom says crash.
But the sources are very clear. Prices won't fall. They'll split.
Exactly. A national crash is basically prevented by that huge supply problem we just talked about and that continuous flow of capital from the diaspora. So instead, you get this rapid and extreme divided market.
So prices are no longer moving together.
Not at all.
But why is Jamaica different? I mean, we've seen other disaster zones where a national correction did happen. What makes the sources so sure it won't here?
They point to two key things. First, the diaspora. Their investment is driven by family and loyalty, not just profit, so the money keeps flowing even in a crisis. Second, there's just a severe lack of developable, low-risk land near the main employment centers. You can't just expand outwards indefinitely. That keeps the pressure on the safe spots.
So the split is all about resilience. Tell us what that looks like in 2026.
Okay, so you'll see stagnation, big discounts, and painfully slow sales in the risk-prone areas, the places that got hit hard or where banks now refuse to write mortgages. Meanwhile, in the resilient areas, the newer buildings, the spots that weathered both storms, values, and rents are going to rise sharply. The market is aggressively re-rating property based on its ability to withstand a climate shock, not just on its post-end.
Resilience has become a measurable, bankable premium.
It's the new luxury.
That shift demands a whole new strategy. So let's get into the practical advice, the 2026 playbook. Let's start with homeowners.
For homeowners, the advice is simple, but it's expensive. Rebuild smarter, not cheaper. The goal has to be future-proofing your asset.
And this means specific technical stuff, right? Not just cosmetic fixes.
Absolutely. Strengthening roofs with proper strapping, improving drainage around the foundation, installing real hurricane shutters, and the paperwork.
The documentation.
It's critical. Every receipt, every engineer's sign-off. You need it for insurance, but you'll also need it for resale. Future buyers will demand proof of the upgrades.
And this brings up a really tough conversation the sources say people have to have.
It's the toughest one. If your home is in a repeatedly flooded, now uninsurable area, does it actually make sense to keep pouring money into it? That emotional decision, invest or relocate, is facing thousands of families.
Okay, let's move to landlords. The sources say they're facing strong demand, but the advice is to act with integrity.
Yes. I mean, the reality is rents will rise, vacancies will disappear. It's a landlord's market.
But there's a warning there.
A strong one. The sources caution against predatory rent increases, it destabilizes communities, and it just invites political pressure for rent control, which undermines long-term value. The smart play is to protect your capital by improving the property's resilience, making it safer for everyone, and offering medium-term leases for stability.
Now for buyers, the message here seems to be, this is not the time for guessing, it's a time for strategy.
100%. The old rule of location, location, location now has a partner. Resilience, resilience, resilience.
So buyers need to rewrite their checklist.
Fundamentally, you have to proactively avoid floodplains and known hazard zones, no matter how appealing they used to be. You have to look for solid construction, good elevation, and documented safety, even if it's a bit further out, and expect financing to be a whole different ballgame.
Right. Banks will want proof of that resilience.
They will demand it. And the key strategic note is this. Don't wait around for some big national crash that probably isn't coming. Invest where the resilience is already baked in, because the value of those properties is only going one way.
And finally, renters. They're facing the most pressure here.
They are. They're competing in the tightest, most expensive part of the market. For them, it's all about protection and planning.
But the advice to avoid low-lying areas isn't practical for everyone. Those are often the only affordable options. So what can they do?
And that's the core social tension, right? The sources say if you can't move, you have to do aggressive due diligence on the unit itself. Maybe prioritize an older but sturdier building that's proven it can stand up to a storm. Check how the landlord did the repairs. Don't accept a patch job.
And lock in a lease if you can.
Lock in a medium-term lease. The rate might be higher now, but it gives you stability. It prevents you from being pushed out by the next price spike. The big takeaway is you have to prioritize safety and structure, even over aesthetics or the lowest possible cost.
Resilience is the new luxury. It's not about the countertops, it's about the roof.
That's it, exactly. And that's the big picture for Jamaica in 2026. It's not a country in collapse. It's a country under massive, noisy, messy reconstruction. It's slower than anyone wants, but it is undeniably happening.
So to sum up the 2026 real estate market, it's active, it's pressured, it's more expensive to build in, and it's more competitive to rent in.
And its value is driven by safety and climate reality, not by nostalgia. 2024 was the wake-up call. 2025 was the reckoning. And 2026 is the rebuilding. Not back to how things were, but to how they must be.
A forced evolution, an absolutely essential one. Thank you for walking us through all of this. It's a picture of immense challenge, but also maybe of building back stronger.
Unnecessary evolution for sure.
Before we go, we want to leave you with one final thought, building on what the sources are saying. If labor is scarce, materials are expensive, and insurance now excludes entire zones, how quickly will this new dividing line between safe homes and risk-prone areas shift the actual demographics inside Jamaica cities?
In other words, will those who can afford resilience end up pricing out those who need it most? It's a critical question of geography, inequality, and opportunity. And it's one that will shape Jamaican society for a long, long time to come.
We'll leave you with that thought. We'll catch you next time for another deep dive.